Yeah, good evening, everyone, and thank you for attending our another round of Masterclass. I'm sure you all been benefited a lot from these Masterclass series. For new attendees, let me give you a quick background of how the genesis of this Masterclass. So I attended couple of meetings at a asset management company, and they were doing this out of purely knowledge-driven exercise, and I thought, why can't we start something similar as a knowledge only initiative wherein we pick up a topic every time and we try to get an expert who has done a lot of work around it and speak about it. Yeah. So I think we did almost 8 such master classes in last 9 months, and I can see a lot of loyalty which we have developed around this master class. So without much ado, let me give you a quick background about today's masterclass. As we all know that investing is all about managing behavior, and I think our expert today can talk more about it. But I have some background about last 20 years. I've seen Nifty has given almost say 12 to 13% CAGR. But when I look at the actual investor performance, that investor performance returns have been between 8 to 9%. And this I'm talking from the actual mutual fund inflow outflow data. So the performance of investors have been 3 to 4% lower than the actual investment return. So why does this happen? Why do investors are not able to generate this kind of return? And as we all know, 4% return over a long period of time, let's say 10 to 15 years on a compounding basis, matters a lot. It does matter a lot. And I can see a lot of people are not able to create a good wealth creation corpus just because they have been switching in, switch it out kind of thing. So that's where this idea of this concept came in, that why don't we do some masterclass on this behavior biases, wherein how can we make our investment decisions better? And this can only be done if we can manage our behavior better. Yeah. So we have with us Mr. Ajit Menon. He's CEO of PGIM Mutual Fund. PGIM manages almost 10,000 plus crores of assets. They have one of the many best performing schemes which they have been managing. And I have seen Ajit's journey over the last 15 years. He has worked with the entire mutual fund. He has seen entire mutual fund industry growing from say 1 lakh crores asset to 30 lakh crores of asset as we speak today. So I'm sure we are going to get a lot of insights and perspectives from Ajit. So Ajit, now over to you. Thank you.
Tarun, yes. Thank you so much for that kind introduction, and welcome to everybody for today's masterclass with TBNG. And yes, I have spent out of my 26 years career, more than 21 of that has been in mutual funds, meeting customers, advisors all across the country, and figuring out that there are a lot of things, especially behavioral habits and biases that we get stuck with, which sometimes detracts away from our objective. These are difficult times for everybody. There's a lot of doom and gloom, and rightly so. The second wave has really caught India unawares. And I'm sure, like me, each one of you have a lot of personal stories about near and dear ones, friends, relatives all across the country who've been affected in the second wave. So I hope that we all remain safe for a little longer as the whole vaccination drive continues. And hopefully there are no more disruptions there. I'm sure that it'll be up and down, but in a few months, I'm sure that things will settle better. For today, when Tarun and I spoke about this masterclass, and I talked, and he was talking to me about whether I could speak in terms of behavioral biases, I said that let me put this behavioral biases in a way that is more relatable, and also something that is a little memorable. It's not just a very pedantic academic exercise, but something that maybe each one of you can sort of relate to, remember, and take back. So I've tried to make it as interesting as I could, and I hope that you find it therefore useful. And I want to start this and tell you what the agenda is going to be. I'm going to speak just about a slide on mythology, which is my sort of favorite subject, and trying to connect it to biases and human biases in particular. But then I'm going to jump into the topic, which is the ZKITBAG. Now, most of you, as you would have seen the invite or seen the topic of the presentation, would be wondering, what is the ZKITBAG? It's essentially an acronym for a process that the Indian Army uses for planning their missions. It's one of the tools that they would use. And therefore, it is something that can help you remember the approach and the sequence of how one can probably, sort of deal with an evolving situation and a challenge that might be in front of you. And of course, using the ZKITBAG to win the investing game. So let me dive straight into this. And as I mentioned, let me start with mythology and the Mahabharata. Now, who doesn't know the Mahabharata? Everybody knows the story. You've heard it from your childhood, from your grandparents or your parents. And we all know the story of the two warring families, the Pandavas and the Kauravas. And, it is embedded in our history. And we love it. We all love it so much. But there is a different perspective that I can give to the Mahabharata. It's called the esoteric meaning of the Mahabharata. A story within a story, a meaning underlying the story. And just to give you what that is, let me tell you it in this way. We all know Dhritarashtra is the blind king. But essentially, what the story is trying to say is that if you look at it, and I'm sure that, when you've heard it from your parents and your grandparents, they would have said that everything that is in the world is in the Mahabharata, and there is nothing that is, not there in the Mahabharata is also not there in the world. And it's all inside a single human being. It's the sort of turmoil that happens within a human being. Very inward looking in that sense, but that's Indian philosophy for you. So when you look at Dhritarashtra, the blind king, it is essentially a representative of the human brain. The brain by itself, which is the sort of nerve center of everything that we sense and perceive and react to, is essentially blind. By itself, it cannot perceive what's around it. It needs stimulus from around it to understand what's going around and react to it. So therefore, if you look at it, the 100 Kauravas, Dhritarashtra's children, they are representative of the negative influences or biases that can happen on the human brain. And it is said that Duryodhan, for instance, represents anger and jealousy, which are probably the worst negative influences that a human being can have, and it can take you down the road to destruction. So the Kauravas are nothing but a representation of the negative influences and biases that happen on the human brain. There comes the heroes, the 5 Pandavas. So who are the 5 Pandavas? They are but our 5 senses of sight, smell, taste, hearing, and touch. Every human being has these 5 senses to be alive and to perceive the world around us. The brain gets the stimulation from these 5 senses, and also, of course, the biases, the negative influences that are there. And what is said is that if you can control the 5 senses, if you are somebody who can balance the 5 senses, then you can reduce the impact of the negative influences and biases. You can defeat the negative influences and biases, perhaps. That is the esoteric meaning of the Mahabharata. But going forward, you look at Draupadi, who is also part of the 5 with the 5 Pandavas. Draupadi represents passion. Now, you can have your 5 senses, but by itself is not enough. All the 5 senses have to be bound together by a common purpose and a passion. It is only then that the human beings, sort of move forward. And of course, you have Krishna, who is representative of the human soul. And to me, when I was, thinking about this mythological or esoteric meaning of the Mahabharata, one character has always sort of intrigued me, and that character is Karna, because we all know that technically Karna is the eldest brother of the 5 Pandavas. So then who is Karna? How does he become part of us as human beings? What is it? And Karna is said to represent ego. And therefore, even though it is an intrinsic part of a human being, it is a part of us, it is one of the brothers. Ultimately, if you want to win, ego has to be suppressed or killed. Only then do you win. And ego leads to almost every issue that a human being tends to face in your personal or professional life. So this, in essence, is a quick summary of my esoteric meaning of the Mahabharata. You can find it all around. It's not my personal view. It's out there. And I've found it very interesting because, I like reading a lot of mythology. And when I came across this, I felt that this is very relevant to share as well. So in a sense, if I were to summarize, it's like saying that our brain is essentially blind and it's influenced by 100 different negative emotions, influences, and biases. But the 5 senses, with the help of an able Sarathi, can win over them. And you will have to let go of your ego, or you will have to suppress your ego if you want to win the ultimate war. So I thought that this makes perfect sense when we talk about negative influences or positive influences or biases that, should be able to get us a perspective to win against all the challenges that we may have ahead of us. Now, jumping into the ZKITBAG, and I said that this is a mission planning tool used by the Indian Army. I came across this from a gentleman called Captain Raghu Raman. I'm sure that many of you would have heard of Captain Raghu Raman, had an opportunity to listen to him probably at some conferences, or maybe even looked at some of his TED Talks or YouTube videos, which are always very fascinating to listen to. Captain, of course, has been 11 years in the Indian Armed Forces, and he's been in corporate life as well. Was the first CEO of the National Intelligence Grid, Group President at Reliance Industries, now with Mahindra's. And he's the author of the book, Every Man's War, and a fellow at the Observer Research Foundation. Now, when I read about the ZKITBAG and Professor Raghu Raman's, sort of rendering of the ZKITBAG as a mission planning tool for the Army, one of the things that he said there is something that struck me as very, very interesting, very, very deep. And this is what he said, right? He said that the Army's lessons are written in blood because mistakes come back in body bag. So the Army's lessons are written in blood because mistakes come back in body bags. What does that mean? It means that the Army, while going on a mission, do not have the luxury of making mistakes. The processes that the Army will follow for any mission have to be so tightly synchronized and sequenced and understood that there should be no scope for error. Sometimes it's difficult to get to. Of course, there will be a plan B and a plan C and a plan D probably, but your mission and your success of your mission really depends on that everything goes right. So your planning process has to be perfect. And I'm going to use the ZKITBAG framework here in today's presentation to give you a quick sense of what I feel might be a framework that we as investors could potentially use to remember the sequence of approaching investments, the sequence of understanding our biases, and the key questions that we can ask of ourselves, and the questions that we can ask from our advisors and our mentors in terms of what is it that you need to do next. So let me first tell you what the acronym ZKITBAG stands for. Z stands for Zamini Nishan. It basically means that, when an army goes for a mission, they know that they're going to fight this in a forest or a mountain or a desert or even inside a city. So what is the geography that they're going to fight on? What is north, south, east, west? What is it in the theater of war? Do you know where you're going to operate? That's the first step. You need to have a deep understanding of the Zameen in which you are operating. That's step number one. The second step, K, stands for Khabar, information, as simple as that. Do you have all the information that you require for making your mission a success? Do you know everything about the territory that you're going to operate in? Do you know how much do you know about the enemy that you're going to encounter? How much do you know about yourself, your team, your resources? All of that information is basically the second most important step when you plan the mission. The third step, which is I, stands for Irrada. Once you know where you're operating and once you have pretty much the kind of information that you need to start off on your journey, and then you set your goal, you might not be able to at the first leg, if your mission is to go and, rescue a whole platoon which has been pinned down on the enemy side, you might not therefore be able to destroy everything that the enemy has, but you might be able to get your colleagues back. Maybe that's the first part of the mission. Whatever be the mission, the Irrada, that has to be absolutely solid. And that is the third step once you have all the information that you have and you set off on your mission. The next T stands for Tariqa, strategy. If you know where you're going to operate, have all the information, and you know what is the goal that you're going to go for. Are you going to blow a bridge? Are you going to lay down mines? Are you going to go rescue your colleagues? Are you going to bomb out an enemy infrastructure? Then for that, what is the strategy that you're going to use? And that is the next important step in this planning framework. The next step, B, stands for Bandobast. If you think that this is the strategy that you're going to use for reaching your goal, then what is the Bandobast that you have done? What are the resources that you have with you for making, that particular strategy very, very complete and useful for that particular goal? Do you have all the Bandobast? Have you done all the Bandobast that you need? Technically, you can use the ZKITBAG framework for a lot of things. You can, even if you're a businessman and you're thinking about writing a business plan, I have used it to write my business plan as well at PGIM for my sales team, early on, just to give perspective and get the right sequence of how we are approaching a particular subject. So Bandobast is about resources. Do you have all the resources that you require to make that mission a success and that strategy a success? A, which is probably the only English word in this acronym, stands for administration, which essentially means that how will you measure progress towards that goal? What the army will do once they know the goal, the Irrada, and the strategy that they're going to follow and the Bandobast that they have done is they're going to make sure that they know how they're going to measure that progress. Whether the platoon or the brigade or whatever is the unit of the army or the air force has gone ahead, have they reached the first milestone, the second milestone within the established time frame that it is supposed to be achieved? All of that is being monitored and reviewed at a certain point, and that gives feedback front and back to adjust on the strategy and on the resources that you might need as well. So it's a very critical step as well. And the last step, which is G, stands for Ghadi Milan, which essentially means that, when a platoon goes out on a mission and when the Irrada and all of the strategy and the Bandobast is discussed, the final step before you step out on that mission is to make sure that every unit of the army or every soldier is synchronized. I mean, their watches are synchronized with the watch of the commander, because it is so time specific when you go out on a mission that if you're going to say that, we're going to start airstrikes by, 21:32, your watch can't be running 10 minutes behind. You could get caught in the crossfire. You need to be synchronized with everything that is happening and the decisions that are being taken by the command headquarters or your commander itself. So that is the ZKITBAG framework for you. Zamini Nishan, Khabar, Irrada, Tariqa, Bandobast, administration, Ghadi Milan. Just a framework, but very, very useful when you think about approaching a challenging subject, a mission, if I may say so, for yourself as an investor. And then let's now dive into understanding the different investor biases that affect all of us. We are ultimately human beings, and what affects all of us and how we can use this framework to try and probably get a sense around all of those. So let me start with Zamini Nishan. The first step. It's nothing but the theater of war, the terrain that you're going to operate in. And your objective is that you must familiarize yourself with that terrain. What is the terrain for our investors? It is the Indian economy and the global economy. It is not just one, it is both. It's the whole world as an investor that is open to us technically and that we must be aware of. Now, when you think about investing, investing is nothing but buying businesses at the end of the day, becoming an owner. And I'm talking of the equity side of the business now, not so much fixed income. So we are talking about buying businesses, becoming an owner. What is a good business? The simple definition of a good business should be that it is a growing business. And what is a growing business? According to us, here at PGIM, and Tarun mentioned, Prudential Global Investment Managers, 10th largest asset manager in the world, $1.5 trillion of investment, technically the largest multinational brand in India today. We have a ringside view of what's happening all over the world. And increasingly, for quite some time now, leveraging human ingenuity and innovation is the primary thing that we look for when we are assessing businesses to invest into. And this is becoming even more stark post the pandemic, was before the pandemic as well, but getting even more stark as we go forward, which is what is growth and what is good growth. And there seems to be, in a very simplistic sense, a big connection to how innovative are those businesses that we're looking at. And that is where we tend to put our focuses. And I can speak about that later as well, but just let me move forward with this. Therefore, when we think about human ingenuity, it is not restricted to India. It is available all over the world. Today, India is approximately a $2.5 trillion market. The global equity market is roughly around $87 trillion. We are very, very small, just about 2.5%, 3% of the global market. However, if you looked at most surveys done by, let's say, even the Reserve Bank of India, 99.99% of the money of Indian investors is just in this Indian market. I guess it's because this is what we know. But there are many, many sectors and companies and businesses which are not present in India or represented on the Indian stock markets at all. And therefore, it is important for an investor to think about the Zamini Nishan. Familiarize that you are not just playing in India. You have an opportunity to play all around the world. Of course, it's a matter of allocation and how much you put here or put there. But please remember that innovation and ingenuity that define growing businesses that make you profit are all over the world. And many of those stocks, many of those companies, many of those business models are not even present in India. And if they're present in India, they're not even on the stock market for you to take advantage of. Let's look at this lockdown that we've had over the last 18 months or so. I'm sure that most of you sit down and watch your favorite programs on Netflix or Amazon Prime. Streaming businesses, not available in India as much to take leverage of, as much as the growth that you see in these businesses available outside. Look at, for instance, we all talk about FANG stocks. We talk about technology and, everybody talks about technology disrupting businesses and focusing on disruption and growth only because of technology. Well, let me tell you that there is one sector that does not get disrupted by technology at all. And that business is luxury. A luxury brand cannot be built overnight like an Airbnb or an Uber. It takes 100 years to build a great luxurious brand like a Ferrari or a Louis Vuitton. And these are stocks that are available out there in the global market for one to capture. So luxury could be one example of a sector that doesn't get disrupted, but sector which is not available in India for you to take benefit of. So why shouldn't one do? So let me summarize, not summarize this, but tell you that what is the human bias that all of us tend to go through when we think about this first step in the sequence, and that is the home bias. Being narrowly focused on just what is visible in front of us in the markets and the newspapers that we read every day. And the question, therefore, that you need to ask yourself as an investor, first one, how narrow or wide is your field of vision for your investments? And that's a key question. So I'm going to leave you with questions to ask. I'm not necessarily giving solutions. I'm hoping that the ZKITBAG framework is interesting for you to think about some critical aspects of your investment journey and then utilize that in your portfolio construction along with Tarun. So this is the first one, Zamini Nishan, familiarize yourself to your terrain. Don't be like the general investors focused all 99.99 in India. Think about the whole world. And there are many great businesses available out there, not in India as yet, and take advantage of that. Increase your field of vision. Let's look at the next step in the sequence, Khabar. Khabar is, Khabar on the enemy first is very important for the army as they get into the mission. Khabar on yourself. But if you think about it, your job here is, do you have actionable intelligence? That's the key word, actionable intelligence. Most of the time, we hear people's opinions. They're not facts. And I'm sure most of you would agree with that, we tend to think about, armchair people giving away their opinions on COVID, its impact and all of that. But what are the facts? And knowing the facts would be, absolutely important for us. So actionable intelligence is what one needs to do when it comes to the second step of the mission planning, which is Khabar. Now let's look at the enemy. And let's look at what you need. What is your filter to gauge your enemy? And here are the 4 enemies that you will have in your investment journey. Inflation, volatility, taxes, and yourself, your personal biases. Those are your 4 enemies in your investment journey to, when Tarun said that, investors have actually got 8 or 9% and not the 13, 14%, there's something that's stopping you from getting there. All of these 4 factors definitely play a role into that. Inflation, of course, interest rates are always connected to inflation. I think for me, the most primary aspect that an investor needs to think about is inflation and interest rates because it affects almost everything related to investments. When you have higher inflation, you tend to get higher interest rates and vice versa. And higher interest rates are good for savers, but bad for businesses. And lower interest rates are bad for savers, but good for businesses. As simple as that. So I hope I'm not simplifying it too much, but I'm just trying to keep it relatable and hopefully even enjoyable to think of it in a slightly different way to get perspective. I do want to take a minute to tell the audience that my personal perspective is that a lot of us don't give importance to the big change that happened in India in 2014 and 2015. After almost 70 years of our independence, something that affects investors is affecting investors and savers quite a lot. If I were to ask any one of you, what is it that changed in 2014 and 15 that dramatically altered the impact for Indian investors, a lot of people are probably going to think Narendra Modi and BJP coming into power. I hope I'm right there. But let me tell you that the really big important thing that happened was Arun Jaitley and Raghuram Rajan together deciding to change the mandate of the Indian Reserve Bank from having a dual objective of controlling inflation and stimulating growth to having a single objective, controlling inflation. Stimulating growth was supposed to be the job of the government. The entire mandate of the Reserve Bank of India was rewritten, was changed constitutionally to say it will be only controlling inflation. That is the biggest change that has probably slipped under a lot of people's radar. Raghuram Rajan and Urjit Patel after him did not just stop there. They made another big change in India in that context. They said, we will not control WPI. We will control the CPI. For 70 years, we were looking at the WPI number. Now we look at the CPI number. The RBI is focused on bringing the inflation that affects the common man down. They didn't stop there. They went one more step ahead and said that that will be a number, 4% plus minus 2. India became one of only 30 countries in the world which have a hard inflation target number, 4% plus minus 2. And many of you would have read that this year they have extended it for the next 5 years at the same range of 4% plus minus 2. Urjit Patel went one step ahead, and he said that the interest rate decision will not be taken by just the Reserve Bank governor, but the MPC, which is made up of 7 individuals, will decide what the interest rate call would be. So therefore, no more influence from a phone call from the government to try and keep numbers here or there. Please believe me when I say that this is the biggest fundamental change that has happened in India that affects investors like you and me. Because the moment you say that you're going to control CPI to a specific number, I'm sure most of you would have realized what happened to real estate, which is one of the favorite investments for most of us, or any other hard assets. Hard assets require inflation to grow. And when you're going to control the CPI down to 4% plus minus 2, that's the rate of return that you're going to expect from hard assets. That is where the financialization of India has started. And more money coming out of hard assets into financial assets. And compounding that flow is the flow and the liquidity that's coming from all over the world. And that explains why the markets are what they are. So I did take a detraction of a couple of minutes to give you an example of why this is so important. Why inflation and interest rates have a sort of a connection to everything that we think and do. So what is the kind of bias that we have here? The bias that we have here is something called herd behavior. Very simple to understand. Too much information from all sources, and especially if you're a digital person, which all of us are, on our WhatsApp most of the time, in different groups, getting different information, different things we subscribe to, newspapers, digital, streaming, whatever it might be. But we have such a lot of information that we tend to forget or tend to not focus on the most fundamental aspect of what will give us the decision-making ability or the actionable intelligence to take decisions. And I'm here to tell you that if you have a reasonably good probability that you want to put to where inflation is going to head and interest rates are going to head, that's pretty much the actionable intelligence that you need to take care of your enemy, of your investment, whatever will affect your investments, whether it be inflation, volatility, or anything else. So that's the second critical step. And the question, therefore, that you ask here is, how do I differentiate between fact and opinion? You're going to hear herd behavior means a lot of information, and most of it is opinion. But what is the fact? Where is inflation? Where is it headed? How is it impacting? How is it going to impact interest rates? Because that's going to have an impact on businesses, and that's going to have an impact on profitability. That's going to have an impact on earnings. That's going to have an impact on your returns. And it does seem that for quite some time, whether it's global or India, inflation is likely to be low, and therefore interest rates are likely to be lower for longer. Good for businesses, good for profit, good for earnings, good for the equity asset class, broadly. So that's another piece that I wanted to leave you with. Let's look at the third piece, Irrada, right? The mission statement, the objective. And here I think that working with Tarun, I'm sure that most of you would be focusing and having discussions around your goals, right? Your short-term and your long-term goals. That's all that should matter for any one of us. And when we look at goals, I think one of the ways to think about it is that it should be SMART goals. S-M-A-R-T, simple, SMART goals. Specific, measurable, achievable, realistic, and time-bound. If your goal does not meet even one of these criteria, it's not a goal. If it's not time-bound, it's not a goal. I want to be rich or whatever. I want to have 50 crores in the bank. But, by when? In 100 years from now or in the next 10, right? If it is not realistic, then it's not a goal. If it's not specific, then it's not a goal. It has to be something measurable and achievable as well. So when it comes to Irrada, the third step of your investment journey and using the ZKITBAG framework, make sure that, your goals, whatever they may be, short or long term, have, fit into this definition of, how to measure it and how to make it achievable, time-bound, specific, or realistic. And I do think that when it comes to goals, the first goal that one should prioritize on is around retirement. And I'd like to call it financial freedom. I don't like to call it retirement, because a lot of surveys that PGIM has done globally and in India says that people don't like the word retirement. It's a very negative word. It has a negative connotation for a lot of people. Oh, what does retirement mean? I've seen my uncle. He bounces from his son's house to his daughter's house, taking his grandkids to school. And, he has a little bit of diabetes and blood pressure and, visits to the doctor. It's a very negative picture that we tend to frame when we say plain vanilla retirement. It's better to think about it as financial freedom. The ability to enjoy your life and do what you want to do, continue working if you have to do, but in the area of your passion, that's financial freedom. It's not about hanging up your boots. And the reason I say that financial freedom in retirement should be your priority number one is because that is the only financial goal in this world for which you do not get a loan. Every financial goal that you have, sending your kids abroad for future studies, starting a business, a marriage, buying a house, buying a car, think about it. You can get a loan for them. The only financial goal for which you don't get a loan is retirement. That you have to do yourself. That you have to put aside yourself. You can't depend on it. Of course, there are things like reverse mortgage and things like that in India, and people tend to think about it. It's not yet a very mature product, but it can be used, yes. It's not something that people have taken to. It has its own sort of shortcomings as well. So I would say that when you think about your goals, your kids will take care of themselves. Don't obsess too much. Of course, you need to plan for them and keep some money aside, but do prioritize your own financial freedom in your retirement. And I think that the bias that you may tend to have during this stage is things like recency bias. And this is the biggest bias during something like a COVID pandemic time, recency bias. Every news that is hitting you, the gloom and doom and the doom scrolling or whatever people call it, pushes you into taking short-term decisions on your long-term plans. You want to become too safe, too risk-averse, or become more risky, or suddenly think about, oh, I want to invest into a farmland somewhere. I mean, you start changing around your plans too much. So recency bias is a very, very strong bias that impacts everybody, which essentially means that the most recent news, whether it's a big negative or a big positive, is going to affect your decision making, and be careful about it. Think about Bitcoin. Recency bias. Oh, wow. I mean, this has gone to 50,000. It's going up, every day. And, how come we're not getting a piece of the action? So, we think about taking a decision. Let's allocate a little bit here or there. And we start changing around what we want to do. I'm not saying that's wrong. But I'm just asking you to be aware. So I want to clarify this. Nothing is right or wrong. What we're trying to do here in this presentation is possibly together, just be aware of some of the biases that can affect our decision-making and judgment. And then we ask the right questions. And the question here is, whatever you want to do, how aligned are they to your priorities, right? So whether it is about, buying that farmland or investing into Bitcoin or doing whatever it is that might be a recency bias playing on your mind, how does that fit into your priorities? How does that synchronize into your priorities? Have they changed? Your priorities can change. Of course, they can change. And do they fit in? And if they do, by all means, go ahead, right? At least you would have taken an informed decision. Now, let's move on and look at Tariqa, right? Strategy, tactics, they're all part of Tariqa. And your objective here, like we talked about, things like actionable intelligence and being aware of your goals and things like that, is you've got to have a strategy and your tactics all aligned towards mitigating risks. That's what your strategy and your tactics should ideally be doing. Apart from, of course, when you mitigate your risks, you obviously increase your probability of making more gains automatically. So let's look at this. You've got a couple of objectives: protection, saving, investment, tax, wealth transfer. I think that this is a sequence. One can't come before the other. It has to start with protection, insurances, I mean, saving, having an emergency fund and things like that. Your investments, then you worry about tax, and then wealth transfer. Sometimes we sort of mix these things up. But to me, I think of it in this way. You've got 7 asset classes for your strategy. 7. Equity, debt or fixed income, gold and precious metals, commodities, currency, real estate, and alternates. Alternates are things like, private equity or hedge funds or investing into paintings and sculptures and Bitcoin. Also alternate asset class. So I would say that if you are thinking about your strategy of investment, here are the 7 things you need to be thinking about. Your proportion and your asset allocation to these 7 and utilizing the sequence of what you need to do. So I want to reiterate this point. The sequence is important. You can't start off on your investment journey if you do not have your protection goals taken care of. Your term insurances, your general insurances, your health insurance, those protection goals. Then your emergency funds and things like that. And maybe for some of you in business and with large pools of money, some of this may not be in the same priority. But I would suggest that if I'm talking to a younger audience, an audience that is just beginning their journey as a profession or working, starting a job, the youngsters amongst us, I would probably ask them to think about it in this sequence so that they don't make too many errors in their journey. So sequence is important. Asset allocation is your key strategy, which means that how do you use these 7 asset classes, which are broadly not correlated to each other? And that is the best way that you can mitigate your risks. When we think about equity, there is large cap, mid cap, small cap, international equity, indexes, ETFs, quite a bit. When you think about fixed income, there is government securities, there is, treasury funds, there are midterm funds, there are all kinds of bonds and debentures that you can think about, AAA, AA, and so on and so forth. When you think about gold and precious metals, there are a few of them. Commodities, again, few of them. Currency, well, we largely play with the dollar, but there are other currencies as well. It's an asset class. And sometimes when you're doing international investing, you also get exposure to currency. So that's good. Real estate, I'm sure we are all exposed to, but then there is residential, there's commercial, and there's land. And alternates, I already mentioned, the whole gamut of, paintings and sculptures and Bitcoin and private equity and things like that. So you have all of this in your sort of weaponry, so to speak, for which you need to think about your strategy. And you need to be building your downside protection into your tactics, right? Your strategy is your asset allocation, but you then build your downside protection, with whatever tactics that you want. And the bias that you're likely to have here is something called risk perception, which is overestimating or underestimating the probability of your bets, right? This risk perception is very, very personal to each one of us. Some of us have a favorite as equity. Some of us have a favorite as real estate. And there are times that we might just go all the way into, thinking about gold and things like that. So you must be aware. Again, I'm clarifying. This is more about awareness about the biases that we may tend to have. We must be aware of our own risk perception and realize that these are uncorrelated assets and you have to have a little bit of all. What proportion you should have is your personal goal-oriented, and along with Tarun, I'm sure that as you all discuss it, what is the allocation that you do for each one of this, right? And the question, therefore, the all-important question you ask for this particular step of the ZKITBAG, your mission planning, is how diversified and how well sequenced is your portfolio. Diversification probably is, according to me, the most important mitigator of risks in a portfolio. We tend to be over-biased towards equity or over-biased towards real estate at times, but it's important to sort of, not just prepare for a rainy day, as somebody said. You've got to prepare for a rainy decade. There are sometimes that, the markets may do nothing for a whole decade. It's not just about 1 year or 6 months and things like that. So some other asset class would be doing well. So you need to balance yourself in your asset allocation out. Let's look at the next one, Bandobast. Resources, your buffer. And here, I think the question is about options, right? What are the options that you consider and how do you think about your bandobast? To me, I think that the bandobast that you do, the preparation that you do is, or rather starts, according to me, with personal health and well-being. There's no amount of money or wealth or returns that you can make that you're going to be able to enjoy if you don't have good health or good well-being, right? And I think that everybody agrees to this. It's much of a no-brainer. But I think that to me, the bandobast that you do is first think about your personal health and well-being, how good you are at that, and do everything you can to keep improving it, working on it. Your personal philosophy. Everybody has a personal philosophy. Question it, think about it, or clarify it if you have to, as far as how you approach investments, what's important for you when you're thinking about investments, transparency or quick turnarounds or growth, or slow and steady, safety. There are many personal philosophies that you may have. Your personal skills are important because they are the personal skills are things that actually have created your wealth in the first place. I mean, if you have personal skills, and you're working somewhere because of your personal skills as an engineer or as a doctor, that's important for you because that's where your income's coming from, right? And your other sources of income, that's the bandobast that you do. You may be getting rental income, you may be getting returns from your investments, you may have hobbies that you can potentially leverage to create more sources of income and all of that. So for me, bandobast is about all of these things. And of course, when you think about the categories of what you have to do in your portfolio, you have insurance, you have mutual funds, you have PMS, you have the liberal remittance scheme where you can take money out of the country, you have loans, you have pensions, you have a will. So all of this is part of your bandobast, right? I did talk about the sequence earlier, protection, saving, investment, tax, wealth transfer. I mean, you can do all of that using these resources that you have. So to me, diversification is the only mantra. You don't stick to one or the other. Concentration is the killer in any of this, right? If you were to just concentrate yourself only in mutual funds or PMSs, or concentrate on leverage to do what you're doing, or concentrate, purely saying, insurances are good enough. I think doing any of that or concentration in your portfolio itself is a bit of a killer. And what is the bias? The bias that investors will have during something like this is being captivated by stories. Okay, because when we think about personal wealth and health and well-being, or your philosophy, when we talk about mutual funds in general, there's a lot of stories out there. Sar utha ke jio. I mean, think about the advertisement, when we look at insurance, and it appeals to us, and a lot of advertising and marketing appeals to us. And we do get captivated by stories when we think about Warren Buffett talks about gold like this, or stocks like this, and we get captivated by those stories, and it's a bias. Some of it is useful, much of it may not be. It's very personal, but as long as you can be aware that this is a bias, that you could be getting captivated by a fantastic story, step back, think about it before you jump into the decision. And the question, therefore, you ask yourself, a no-brainer again, is how are the stories that I'm hearing about equity, or the story about small cap or gold or whatever it is, how is that influencing the selection of my options, right? Now let's look at administration. We are very close to the end of the presentation. I hope that it's not been boring so far. I've almost taken an hour, though Tarun gave me half an hour to 40 minutes. But I hope that it's still interesting. So here we go. Administration.
So Ajit, we have a lot of questions also coming in. Yes. Okay. So I think let's complete these two pointers, and then we can start with the Q&A.
Of course, we can do that. So administration, which is metrics of measurement, monitoring, which is essentially your frequency of review. I think what is important is what is your benchmark and what is your time to goal. Those are the two things that you think about when you're measuring anything. And to me, I think that a bank FD is a good benchmark to keep, because if you didn't invest and you just saved your money somewhere, you would just be putting it in bank deposits. So I would use that as a benchmark. As just an example, you can use whatever you want. and the nominal growth of a country's economy is probably a number that you want to keep in mind, because much of equity works off from there. Of course, you've got to remember that you will have individual inflation in your household. Just by RBI controlling CPI to 4% plus minus 2 is not what affects you. You may have parents at home who have sometimes medical conditions. You may have children who are ready to go abroad to premier schools. And therefore, inflation in education and health costs are very, very high. So, you could end up having a very different inflation. But let's look at the bias. It's essentially result orientation. When you're thinking about, measuring things, you end up thinking, you're judging your decision only by the end result. Did I get a 14% compounded return or not? And why didn't I get it? And things like that. And I think the way to think about it, the question to ask when you're measuring or monitoring things is, what was the premise when I took the decision, when I invested in something? Has that premise changed? If that premise has changed, then you need to question what you're doing. But if the premise hasn't changed, what you're looking at probably is a temporary blip in something that's happened. So the most important thing is to think about your premise of decision-making when you started off, when you discussed with your advisor and thought about, here's what you're going to do, here's going to be a percentage asset allocation. And if you think your premise is changing, only then change it. If your premise hasn't changed, then it's a recency bias that's acting on you to make changes. So be aware of that. The last step, Ghadi Milan, which is essentially synchronize, right? And be in sync with a commander, whoever that might be, a North Star. And essentially, to me, I think in the investment journey, this is about being disciplined and also having a trusted third party to guide you. Here's where probably an advisor comes in, the person who's your North Star, who thinks about, synchronizing things for you, having a discussion with you and helping you out in terms of where you want to head. And the reason that is useful is because money decisions have very, very strong emotional influences. If it's your own money and you're managing it yourself, you will tend to, have those biases affect your recency bias, and all of those affect your decision-making. You can have a good trusted third party guide you. And what you need is trust, right? And when you think about trust, the only thing that you look at is that, do you have the required empathy and integrity, the competence and credibility and reliability in that relationship that you have? And if you tick all of those boxes, you pretty much know that you have your commander, your advisor, somebody to synchronize yourself with on your investment journey. And the bias that will tend to come up in this space is overconfidence. The belief that sometimes that, we know how to control the market, even though we know that it is essentially random, at least in the short term. We tend to think that, oh, we took a great decision, look at it, and we did the right thing. So therefore, I can extend it to everything else as well. May not necessarily be. Or sometimes it could help you, of course. I'm not saying it doesn't work. But overconfidence is something to be aware of. And just make sure that, you can bounce off your theories and ideas and then take whatever decision that you need. So how synchronized are you with your plan? So here, when I say Ghadi Milan and synchronize and commander, I'm saying it's your financial plan. That's your commander. Are you in sync with them? And of course, here's an advisor, a sarathi, a coach, whatever you call it, who can help you make sure that you're not going off track. So let's summarize very quickly. We saw Zamini Nishan, terrain, Khabar, information, Irrada, goal, your strategy, resources, review, discipline. What are the challenges? A home bias, which means you could have a narrow field, widen your scope. Information, you could have a herd behavior, which means that you might end up just chasing returns based on what's happening out there. Be very, very careful about your filters. A goal, your goals could get affected by recency bias, short-term things that are happening in and around of us affect us. Make sure that you're prioritized. Your strategy, well, one of the challenges you could have is risk perception of how you look at risk for various asset classes that you might have, and you might end up oversimplifying. Just stay true to your asset allocation. Make sure that you have as many asset classes out of the 7 I spoke about with you, and allocation, therefore, is the approach that you take there. When you think about your resources that you have, make sure that you're not wrongly resourcing yourself because of the stories that you're hearing around you, and make sure that you've got your sequence in order. When you review your portfolios and your returns, you will have result orientation, looking and reacting to something that you expect to happen, but make sure that you're reviewing your decisions that you took beforehand and making sure that those premises have not changed. And of course, overconfidence when in your final step, when you think that, hey, you got it, and you can make a difference, maybe you could, all power to you. But then the fact is, sometimes that can lead you into, because you're trying to control randomness, and therefore it's good to have an advisor sync and a plan sync. So when you think about the ZKITBAG, the army also says that while this is a great planning framework, the battle plan is the first casualty of war. So you should not cast your plan so much in stone that it is not flexible, because ultimately, I think as Morgan Housel puts it, it's very simple. As long as you're spending less than you earn and you save the difference and you take the help of a good advisor to invest in a diversified portfolio and have patience, you should be well on your journey to have a good return on your portfolio. So thank you very much. I think that's the end of my presentation. I'm not seeing the questions as yet, but Tarun, you can give me the questions.
Sure. So
let's get into that. I'll stop sharing here and move into the questions. Thanks, Tarun.
Thank you so much, Ajit. I think before we start the Q&A thing, I want to quickly run a poll on your screen, because there are a lot of questions which we want to run, but I want to know some outputs coming in from all of you about how you are behaving. So I have just launched a poll on your screen. Just quickly take this poll. I just want to know that how are we managing our behavior in investing? So these are some questions related to that. So Ajit, I think we'll wait for just 30 seconds and then we can start that.
Of course. So I'm going to look at what I got on question 3 for sure.
So I have my first question is, what is the long-term definition of equity investment? And I have seen that people, for someone, a 1 year or 6 month is a very long term. And for some, a 3 year, 5 year, 10 year, 15 years is a long term. So what is the definition? And I think from the audience, I want to know, how do they feel? What do they feel about it? Again, we were talking about behavior. A question which came to my mind was, post-COVID, we have seen a 40% correction in the market happening. And at that point of time, trust me, out of my 100 clients, I have got calls from a couple of them, and they panicked and they felt that world is going to end. And they felt that this is the time we need to offload everything, get out of everything. The pandemic is going to have a very, very big impact on economy and everything. Yes, it had impact, but who would have forecasted that markets will behave like that? So again, I want to know who all have been the net buyers and sellers. And I can see a lot of sellers coming in out there. So I think, I think people have reacted opposite. Yeah. And yeah, I think these were the 2 big questions I wanted to get a poll.
Okay.
Yes, I think a lot of people have answered. So I have just ended the poll. So I'll just speak out the results. So what is the long-term definition of equity investment? So less than 3 year, 8% of the people feel equity should be kept. Almost 51% of the people feel a 5 year is a good equity investment horizon. And 49% feel that 10 year plus is a good equity investment horizon. I think, Ajit, are you seeing your investment flows happening like this? I'm sure you know the folio situations in your mutual funds. Do you see people behaving well for 10 years in equities?
What I have found, Tarun, is that it depends on the advisors many a time that clients do have. So what I mean by that is that a lot of customers who go direct, investing direct in mutual funds, or if they are just using general, distributors in the marketplace, they tend to have shorter timeframes of investment. But if clients are largely through advisors who have long years of experience, follow a more or less financial planning approach to investing, goal-based approach to investing, there the timeframes are much longer, for sure.
Wow, great. So I think on the second interesting question, were you a net buyer or seller in equity post-COVID after 2020? I can see 51% were net buyers. So we have a lot of sophisticated investors out here. So people have been actually buying, and 16% were net sellers and 41% are neutral. they don't know what to do. So I think, Ajit, what has been the trend you have observed in the actual flows coming in post-COVID?
Well, I think that, firstly, let me say that maybe that 41% who says neutral is not people who didn't know what to do, but they basically took the decision not to do anything, which is a great strategy to do when you are thinking about long-term investment. So it's a good decision that way. But I think that if you looked at the numbers for the industry, Tarun, the equity asset class in mutual funds was close to 58,000 crore negative net, which means that money went out, right? And so I think it reflects on the general audience has actually have sold. And of course, a pandemic where people have lost jobs or where businesses have stopped would have meant that they would have had to draw down on their investments. My feeling is that when I spoke about in the presentation about the sequence of protection and savings, I meant the emergency funds. So if people had already planned around their emergency funds, they would have not needed to touch their investments to tide over a difficult time for 6 or 8 months. So maybe one decision to take is that if you have emergency funds in your plan, which has typically been 6 months of expenses or so, maybe the one premise change that you could do is, keep a 1-year emergency fund. That might be something that, you might want to take as a decision because of this event. Of course, a lot of people even keep longer, but I think 6 months to a year is good enough. And so nothing wrong there. That's an important thing for people to consider.
Ajit, one more important thing you spoke about was the Khabar. I think how beautifully you have entirely the story making. You tried creating story around this behavior concept. I always feel it's so hard to explain these behavior concepts, and people feel these are so technical words, and we don't want to understand that. And I think this Zamini, this ZKITBAG, how you tried to explain the Khabar part, and let me tell you, the investors I deal with, the Khabar part is the one where people get a lot of consciousness is there on the Khabar part. And I'll tell you a small example of a company called Oxygen Limited. And I can see in the COVID, currently there is a lot of scarcity of oxygen. And I can see the stock of this Oxygen Limited went up by 40-50% in 2-3 days, 5 days sessions. I tried investigating what is this company, and I came to know this company is in NBFC sector. And to my surprise, I think people just reacted based on the name. This is herd mentality, where people are just entering because of the herd. And you mentioned that this Khabar part can be taken care of if we are focused on around our financial goals. But again, things are changing. I think they are so dynamically changing for us. How can one stay calm in this period where there is so much noise every minute, every day? People are hooked on to this WhatsApp university where you get so many things coming in. So what is the secret sauce according to you on this
Bandobast?
Hard?
The secret is the step of Bandobast that I spoke about in the process, where I said that your personal health and well-being, your personal philosophy, and your personal skills are important for you to sort of consider. And the reason I say it is because, what can help you is if you can clarify around your own philosophy, your own first principles, as to speak, as to what will you do when you get information. Firstly, is it opinion or is it fact, right? You've got to make that distinction between an opinion and a fact, and then take decisions based on your philosophy. What is your source of information? So Tarun, I have not watched TV for the last, I think 20 years or so now. I mean, I don't watch news at all. It's not that I don't keep in touch with news because, we are in the investment world. So I tend to listen to news on a podcast on my morning walk. And, 20 minutes, I'm done. You get a global roundup from BBC and you get a local roundup from maybe Bloomberg Quint or whatever. And that's more than enough to get a sense of it. And then there are a few people that I follow for, the information around different policies or what's happening around the world. I look at a lot of thought leadership research reports that are done by, various research houses and investment houses. Those are very important to read because it is important to get your first principles of a global macro right. Once you get the global macro right, then you can put everything else in context and then take decisions. And to me, I did mention during the presentation that inflation and having a view around inflation is probably the critical thing to do, so that you get a sense around, how is investments going to get impacted, how are interest rates likely to move, and so on and so forth. So I try and keep things simple. I don't want to get too much bombarded by news from the news channels. It's been a long time. I've not missed anything by not watching news. Follow a few people who you find credible. So your source of information should be good, and something that you feel is not just your own viewpoint, but also contrarian viewpoints, so that you can make an informed decision. Split opinion from fact as much as you can when you see some very compelling story, and ultimately then ask the question, how is this all going to roll into inflation and interest rates? Once you get there, you're pretty much sorted in terms of whether you should react or not.
Sure. Another important question, Ajit, which is coming to my mind is on the Zameen part. You spoke about the familiarity bias, right, on the Zameen thing. And I think if you ask me, as an individual, we all have some belief system. We have been all taught something from as a child. Only invest in property, only invest in gold. We have all made money out there. I think you were talking about global, but I think I am fighting with my clients to get their money from property to financial assets. That is the first challenge what I am observing. So global is a far-fetched, sophisticated product according to me. But yes, as we talk right now, I feel this is so important to be diversified outside India. Why should you have all the money only in India? And I'm sure you belong to an asset manager who has a presence across the globe. What has been your learnings and insights while investing across the globe? That how this diversification actually benefits?
Okay, let me give it to you in two parts, Tarun. And the first is to remember that when you hear advice from your parents, or even from advisors, I mean, you and me, for instance, all of us have our own personal biases. Because of the life and experiences that we have had, because of our age, because of the time that we were born and how the world was and what we saw as risk, right? So people who were born post the Second World War, called the baby boomers, they were the ones who did not want to ever have a war again, because they had seen the devastation of war. And, that's when the flower power and the, as you know, between 1945 and 1960, people who were born at that point of time, they have a certain strong philosophy, right? That you should invest in gold, you should invest in land, and you should invest in property. So if you see more of the older generations, they would have taught their younger generations कि भाई हमने यही पैसे बनाए हैं, हमको यही करना है, this is what is important for us. Then you look at the people who were born between the 70s and the 80s, 90s. If you think about those people, what advice are they giving their children? Most of the people who have become adults during that time, which is called Generation X, is equity. Because the world, by then, after the World War had done well, the infrastructure was up, markets had loosened up, the dollar was deep pegged, and you had equity markets doing very well around the world, and people made money in stocks. So, most people who have become adults during that generation think equity is the answer for everything. Then you have a new generation of people who have been born post the 90s. I would say many of our teenage children, if many amongst our audience have teenage children, I'm sure you talk to them and they will only be thinking technology. Saying, boss, ye sab purana ho gaya, ye sab, this is all old world. You just got to have FANG stocks and Apple and this and Tesla and whatever, because technology is everything, it's disrupting everything. And so they are very tuned towards saying that is what is important. You don't need to own assets and land and things. You don't need to own a car. You can Uber it, you can, Ola it and things like that. So I think that the first thing to remember is that when you hear advice and when you feel that this is what your father taught you, or some of your best friends or people that you respect very much taught you, please remember that they've all come from a certain context of their life, including Mr. Warren Buffett, right? So when you think about that aspect of it, you start realizing that, you must be aware that that is not what you should be following. You should be following asset allocation by saying that there are 7 asset classes. Those 7 asset classes behave differently. As long as you have a strategy of mitigating risk by spreading yourself across those 7 asset classes, you're pretty much safe, because you never know what is going to work next. Is it gold? Is it going to be, growth stocks? Is it going to be commodities or it's going to be something else? So when you think about PGIM and Prudential, and they have been 140 years in this world, they have seen 30 different business cycles. What are they saying? What they are saying is that there are many structural changes in the world that one must be aware of. Okay, the structural changes that are happening in the world are essentially, if you think about it, is that the world is getting older. So most parts of the world are demographically is older, which means productivity is getting challenged. There is high liquidity, which is likely to sustain for a long time. So liquidity will impact a lot of asset classes as well and keep interest rates low for much longer. China has finished its, very, very strong period of growth. So the sort of coming to an end of the investment cycle within China is something that will play through into things like commodities. Technology is creating a disruption all over the world, and inflation is remaining quite benign if you think about what has happened since globalization took off, where supply chains were not so much of a problem. Costs have gone down and inflation has reasonably been benign. And countries are now awash in debt as well. So if you put these very big fundamental aspects together, the fact that the world is getting older, barring countries like India, where we are still young, productivity is low, consumption demand has gone down all over the world, inflation is therefore low, interest rates are likely to remain low, and the Chinese growth has also sort of stabilized. What Prudential is saying that all of these structural changes are something that you got to understand at a macro level. So you have to be very stock specific in your portfolio for fund managers, right? You can't just look at an index and say, "Ha, ye index ko track karna hai," because the index has a lot of old world stocks, whether it is commodity driven stocks or energy driven stocks and things like that, which potentially don't have any further to go. Then you look at climate change and what impact that is going to have because of the Paris Accord, and how private equity money and large pools of money are going to put pressure on companies to follow certain guidelines when it comes to climate change. Which companies will win that or not win that? Payment mechanisms have changed. The consumer is more Asian now than the rest of the world. So what Prudential is therefore saying, Tarun, is that you got to put all of these things into consideration when you're taking a call on your investments. And it is best to be growth oriented and be more oriented towards, what are the new economy stocks that are out there across the world and also in India. That is something that we need to do. And what we have changed in our investment process, Tarun, therefore, is that our universe, and tracking exactly what Prudential does abroad, is that we focus on positive operating cash flow companies. Across sectors, we look for companies which have 10-year track records of at least 7 years out of 10 positive operating cash flows. Why do we look at 7-year positive operating cash flows out of 10? Because normally business cycles are of 5 years. And if a company has positive cash flows for 7 years, it means that they have cash flow even at the bottom of the business cycle. If they have a positive cash flow even at the bottom of the business cycle, they're resilient businesses that can always bounce back. So looking at what the investment process is, all of those are important. Long answer to a short question, but I hope that's useful.
But Ajit, what is the quick bulleted percentage of domestic versus international asset one need to equity? If I have to talk about, what is that percentage? What is that sweet percentage one should look at?
See, I feel that firstly, you decide the overall equity exposure, right? And within that, how much should be your international equity? So if I were to follow the thumb rule of 100 minus age, just for the sake of it, it's not a very, it's everybody has a personal asset allocation they should follow. But if I were to just give you a very easy thing to teach your children, for instance, your equity allocation is 100 minus age. So if you're a 30-year-old person, then 100 minus 30, you should have about 70% of your investments in equity as an asset class, right? Because you have long term ahead of you. Within that 70, you could have 10 to 15% in international equities is what I would normally recommend. If you have children studying abroad, or if you tend to travel abroad and have business interests abroad, then I would probably say even go from 15 to 20% as well in your international equity allocation. Everybody should have some, for sure. because as I mentioned, there are many stocks and sectors out there which are not available in India, in the Indian stock markets. And so that would be what I would recommend.
Brilliant, brilliant. Another question coming in from Vivek, and can you share story of a successful investor? It's a very long question, and what they have done over last 20 years, and an unsuccessful investor as well in the same situation, who was unable to make best of the market due to behavior bias. Consistently being invested versus changing asset class based on valuation. Example of certain PE. Second is asset class allocation ratio between large, mid, and small cap, and diversifying between gold, real estate, equity. What's the right ratio?
Okay, so I think this is a very, a question which, you need to have a long answer to, where you sit with your advisor, and Tarun, you would probably be best placed to give advice in terms of what the ratio should be and, what one should look at. But, if you go out there in literature, you will find many examples of people who have made long-term wealth by simply squirreling away money into equity stocks or an equity index or a good portfolio, diversified portfolio for a very, very long period of time without actually touching those investments. There's enough surveys to talk about people who tend to move in and out of the market based on their behavioral biases, who lose out on taking the full advantage of markets. So there are examples. And even if you look at hedge funds like the long-term capital group, which went bust, these were a bunch of PhDs actually, and Nobel Prize winners who had built portfolios, but they had leveraged themselves too much. And, ultimately those portfolios cracked. Whereas if you look at people who would have just squirreled away their SIPs into investments over long periods of time, they would have probably made more wealth. I can tell you that, in a question like this, I would probably call myself a successful investor, and I credit it completely to my advisor, who has been with me for over 8 or 9 years now, working to a financial plan and making sure that I am having investments according to my goals. I have 2 children. My daughter is in the US studying for a first semester. She's due back tomorrow. After her first semester, she went to Boston University. I have a 14-year-old son. I'm fully funded for their, for their international education, because my advisor helped me understand my overallocation to real estate, which I then sold and parked that into an asset allocation, which included equity, fixed income, and gold. And so I think that, I have a 14% or CAGR on my portfolio for long years now. I think that's a fair return. I should be having a between 10 and 11% for my financial goals. So at 14, I am probably doing well for my investments so far. And I'm completely diversified across all asset classes, including rates, and, also have a will in place. So I think that, a question like this should be answered with what a person is personally doing. And I would say that my success comes from having a financial advisor who has helped me understand my cash flows, my protection requirements. Am I in the right insurance plans or the wrong ones? What are the smart decisions to take over there? Are my nominations done properly? Cleaning up all of that, making sure that I have an emergency fund, in place in fixed income, and then making my investments aligned to my goals as far as my retirement is concerned and things like that. I have a few goals. It's for my 2 kids, for their education. I have the goal for our retirement. I have even a financial goal for my housekeeper, who's been with me now for 20 years since my kids have gone up, to make sure that when she retires, she's 55, and I think she is also getting old, in another 3 or 4 years' time, as my son gets ready to go abroad or study or go out of Bombay or wherever. Maybe she'll want to retire and have a pension. So I have built up a pension plan for her as well as part of my financial plan. So I think those are the kind of goals that I've designed for myself, and I think I'm okay on that.
Thank you. What an answer, Ajit.
And of course, it was a long question in terms of, allocation towards gold and real estate and things like that. I feel that, since inflation is under control and is likely to be under control for a much longer period, I would not be very bullish on real estate or any hard asset. I'd probably not make it more than 20 or 25% of my portfolio. I do think that low interest rates for longer and benign inflation is always good for businesses and equity. So I'll probably go heavier on equity for about maybe 40% or 45%. So 45% plus the, 40% plus the 25% in real estate would make it about 65. And then for the balance 35, I'd make sure that, I have about 5% in gold, not more than that 5%. And the balance about, 30% is in fixed income. And I have actually, in my real estate, I actually have some rates as well that I've sort of invested into. And in my equities, I am close to about 10% in my international, about 12% in my international equities.
Another question coming in from KU, what is the ideal split? And I think it was just related to the last question, but what is the ideal split percentage basis within the asset classes? How much in stocks, how much in real estate, how much in gold? I think Keyur bhai, Ajit already mentioned about it. It needs to be based on your suitability.
Yeah.
What is your risk tolerance level? What is the ideal asset allocation you are comfortable with? And this need to be a very individualistic exercise. Yeah. Ajit, you want to add on anything on that?
Just one point. Please remember that everything that you and I as investors know about wealth management and making money came from a Nobel Prize winner called Harry Markowitz in the 1960s. He was the one who designed the efficient frontier theory in investments, optimized portfolios and asset allocation. And this came about in the 60s. Before that, most people would just go to their tax consultant and decide what to invest. Once the efficient frontier theory came into being and about how to optimize portfolios on an asset allocation, that came from this gentleman called Harry Markowitz. He's a Nobel Prize winner. Harry Markowitz was asked about his own portfolio. And he said that, listen, I always feel that, what if my money is outside the equity market and the market goes up and I lose all the returns? But what if my money is in the equity market and the equity market goes down and I lose my money as well? So my portfolio is 50-50, equity and fixed income. So the man who designed the whole wealth management theory, optimized asset allocation or whatever, his personal allocation was 50-50 in equity and fixed income. So the reason I'm telling you this is just to say that if you're confused, it's always good to say, 1 by N. 1 by N is essentially if you have 5 asset classes, 20, 20, 20, 20, 20, you're good to go, right? But the better way is to sit with your advisor and decide what's important for you based on your goals.
Nice. Ajit, we are completely out of time, but I think we'll take the last question and
Sure.
maybe your final departing insights.
Sure.
So how do funds, so this is question from Sanjay, how do funds or advisors act differently than individuals? Very important question. Who may invest, but then asset zooms and tend to seem euphoric, kind of 3-year returns in a year. Like this year in equity, if one sell, then it change of plan. If hold on, then it's not being conservative. So how do you want to address this question?
Can you sort of repeat that question, Tarun, in terms of,
so I
is
think
it about
this
how
question,
to take a decision when you receive advice?
No, I think his question is what I feel like is doing directly versus doing with the help of a fund house or an advisor. I think how do they act differently than individuals? Why do you genuinely need them? Right. So maybe I think his question is, can I pick up stocks myself? Why should I buy a mutual fund? Can I manage my money myself?
You can.
Spoke about emotional management also.
Yeah. So there is nothing right or wrong. I think that, experts like me or anybody else who comes and says, this is one rule, that is second rule. I would prefer, like I said during this presentation, be aware. And then if it suits you, take that decision. At least ask the right questions before you take that decision. So when you think about why do you need an advisor, will they give you better advice than you doing it individually? The question you probably need to ask yourself is, do you have all the time in the world to keep monitoring what's happening in the portfolios? Because an advisor essentially has a back office where, most portfolios, markets are being tracked and some alerts are being done. Today, COVID time, everybody's at home. People have got more time on their hands. They think they can be direct investors. Some of them can definitely be, but it's not going to be the scenario all along. At the same time, there are people who may have withdrawn from the mutual fund market and invested into direct stocks themselves. Some would have done well, some would have not done well, but broadly, they would have felt that koi farak nahi hai. So there is no right or wrong answer for this. I think you have to do what, like I said, your bandobast, your personal philosophy is on this. I would probably say that if you want to do it, you test if you have to. So if you have 100 rupees, which you're investing, maybe invest 50 rupees yourself and give 50 rupees to an advisor to invest. And after 2 years, take a decision whether you did well or the advisor. Then you take a decision whether you don't want the advisor or you can do it yourself. And I feel that it's better than to experiment that way. Or if you feel that, okay, an advisor is helpful because he or she helps you monitor and review your portfolios, access different asset classes, then 80% of your investments can go through an advisor. If you think that you have some play money, 5 rupees, 10 rupees, 20 rupees, whatever you define, use that for your personal investments, and you have some ideas you want to work on, maybe you can do that. There's no harm in that. There is no fixed rule here. They say that only advisors will do good for you. But if that is true, the corollary is also true. There is nothing to say that you doing it yourself is also going to mean that it is going to all be hunky-dory and good, right? So it's always a balance. And I think you've got to do what suits you. So you've got to ask the right questions of your advisor. If you feel the trust and confidence, then do it yourself. I don't think it's a great comparison, but it's almost like thinking about a lot of people self-medicate when you have an illness or some problem. Sometimes it's okay. You pop a crocin and it's fine. But sometimes you need to see a specialist, right? So that's the role that you got to decide. But please remember, are you meeting a chemist or are you meeting a doctor? That's a decision you need to take.
Thank you so much, Ajit. And maybe you want to end with some perspective post-COVID. How do you see the next 3 years, 5 years, 10 years? I know it's very fluid. No, everything is very fragile. The way things are, all the assumptions are going wrong. But what is your take on various asset classes going forward for, say, next 2 years, 3 years, 5 years? What do you feel, which kind of asset classes are going to do well in this environment where we are in right now? So and maybe we can end it with this question. Yeah.
So I think, Tarun, that like I said in the presentation itself, and I follow that myself, is that, personally, when I think about listening to information, getting them, podcasts, whatever I'm reading, I'm only trying to get a sense about what do I think about inflation over the next 3, 5, or 10 years, right? To me, it seems like there could be a temporary blip to inflation if most countries are becoming very, very nationalistic, and this fight between US and China and disruption of supply chains, which could temporarily increase costs of certain things. That's inflation at the end of the day. But I think it's going to be temporary. I think the benefits of globalization, the benefits of technology is essentially going to mean that inflation will likely be more benign. And if inflation is going to be benign, that means at least in the next 3, 5 years as we look at it, I think that, what is going to happen is interest rates are going to remain low. If interest rates and inflation are going to remain low, then I don't think you're going to make too much money out of maybe real estate or gold, but you must have that allocation. So your personal residence or whatever that you invested into, if you're getting a good deal, you've done that, that's absolutely fine, because that's your own home that you're going to stay with. And you have maybe one investment home as your real estate exposure in your total that you have, but it should be a lower percentage is what I would think on your total portfolio. And because of my call that inflation is going to remain reasonably benign over the next 3, 5 years, and interest rates therefore are going to remain low, I would always be positive on the equity asset class. Now, when it comes to fixed income asset class, interest rates are already low. Is there a scope of interest rates going lower? Possible. If this economic challenges continue, world over, interest rates and central banks have promised to keep interest rates lower. So it's likely that, what are you going to get out of fixed income? Not much, but that's where your emergency funds would go. That's where your uncorrelated asset will go from equity. You can't take the all risk on equity. If interest rates do go up and we are wrong and inflation shoots up for a much longer period, then your fixed income is going to come to your rescue if you're sticking to fixed income for a longer time, of course, not at the immediate period when it happens. So you must have that allocation to fixed income. Risk, if you want to play, like I said, my allocation, since I have a bit of gold and my fixed income, I think I'm fine with that allocation. So my answer in brief is, or rather in a summary is, take a call on inflation. And if you get a call on inflation right, you know where interest rates are headed. That allows you to take a decision on every other asset class.
Thank you so much, Ajit. And thank you very much, everyone, for joining us and giving your valuable time to this masterclass. Thank you so much. Thank you so much. Thank you, Ajit.
Thanks, Tarun.